issued by the company, then steps in the issue of shares, what are the various legal provisions related to the issue of shares, and then the accounting perspective of this entire share capital. So as you all know, there are primarily two sources of raising long-term funds for the company form of organization. One is obviously through the owner's contribution, which is called share capital, or also called as owned capital. And the other form of raising the funds, long-term funds, is basically through loans, which is called the borrowings, long-term borrowings. And primary source of long-term borrowings is debentures. And these loans can be taken from banks, financial institutions, or the individuals. So these are primarily the two sources of raising long-term funds for any kind of company form of organization. In this chapter, what we are going to study is the first one, that is the owned capital or the share capital. So what is owned capital? So owned capital is basically the owner's contribution to the company. That is why it is called owned capital. Owners are nothing but the shareholders of the company. Hence this is called as share capital. So collectively, all the shareholders are the owners of the company, and each individual shareholder owns the company to the extent of his share in the entire share capital. And that is why the contribution made by the shareholders is called as share capital. And there are two types of shares that the company can issue. One is called equity shares and another is called preference shares. These are the two types of shares. Now coming to issue of shares at premium. Now if the face value of the share is 10 rupees, which is so as you all know, so what is preference shares? Now in the name itself there is a word preference. So that means definitely such kind of a share must be carrying some kind of a preference over the other equity shares. So in what areas or aspects this share carries preference? So it carries preference over equity shares in the following two areas. One, payment of dividend at fixed rate, and the second preference is in the matter of returning the capital at the time of winding up of the company. So what we mean by this is that whenever company wants to pay dividend out of the funds, out of the profits available for the company, the dividend will be paid to the preference shareholders and at a fixed rate of dividend. So when we talk about preference shares, we always say 10% preference shares, 12% preference shares. What we mean by this 10% or 12% is nothing but the rate of dividend. So if it is 10% preference shares, the dividend rate is 10%. This 10% will be of the nominal value of the preference shares. So whenever the dividend is declared, first priority will be given to the preference shareholders. After the dividend to the preference shareholders is paid, if still there is profit left, then out of that remaining profit, the dividend will be paid to the equity shareholders. So that is why in that area, in terms of in the area of payment of dividend, preference shareholders carry the preference. They carry the priority. And the second is equity shareholders or preference shareholders. They are the owners of the company. So they will be the last people to get the money from the company at the time of winding up. Now, in terms of the priority, the preference shareholders carry the preference over the equity shareholders. So in case of winding up of the company, first out of the funds left over after all the other liabilities are paid off, first the preference shareholders will be paid back their capital, and after that, if still the funds are left, then out of those funds, last people will be the equity shareholders to get their capital back. So that is why the name preference shares. Now preference shareholders will have a voting right only on the matters which affect the rights attached to their preference shares. Otherwise, the matters which are not affecting their rights, preference shareholders' rights, on those matters they will not have a voting right. So like for example, if the company decides to change the rate of dividend for the preference shareholders from 10% to 12%. Now obviously this is or 12% to 10%. Obviously this is a matter which is related to the preference shareholders, and that is why on such kind of matter they can vote, but not on the other matters which are not related to the rights of the preference shareholders. And another area where they can vote on is basically the resolution for the winding up of the company. Obviously the winding up of the company affects the equity shareholders as well as the preference shareholders. So that is why on such resolution, even the preference shareholders will have a voting right. And repayment or reduction of equity or preference share capital. When the capital goes down, on such kind of items, the preference shareholders will have a voting right. But other than these items, on other items, the preference shareholders do not carry any voting right. Now, this is a general rule. But however, the Act further says that if the dividend is not paid to these preference shareholders for 2 years or more, then these preference shareholders will have a voting right on all the resolutions in the general meeting. So they will stand at par with the equity shareholders as far as the voting right is concerned. Only if the dividend is unpaid, so it is declared but not paid for 2 years or more. So they become like an aggrieved party, and that is why they can vote on any matter in the general body meeting. Now there are various types of preference shares which can be issued by the company. One type is called one category is called participating preference shares versus non-participating preference shares. Now what is this participating versus non-participating? Earlier I said, each preference share normally carries a fixed rate of dividend. So say for example 12% preference shares. Now suppose, this 12% dividend is paid to the preference shareholders. After payment of the preference share dividend, still the profit is left. Now normally what happens is, out of that remaining profit, the dividend will be paid to the equity shareholders. But if these preference shares are participating preference shares, then out of the leftover profit, not only the equity shareholders will get the dividend, but along with them, again simultaneously the preference shareholders also will get the dividend out of the leftover profit. So they first of all get their fixed rate of dividend, which is in our example 12%. On top of that, out of the remaining profit, they will get the dividend along with the other equity shareholders. So they participate in the leftover profit. That is why the name participating preference shares. Versus non-participating is simple. If it is 12% preference share, once this 12% dividend is paid to them, then in the leftover profit, they will not have any right to claim dividend. So that is non-participating preference shares. Another category, redeemable versus irredeemable. Now redeemable, the simple dictionary meaning, it means the capital which is repayable back to the preference shareholders. So that is redeemable preference share. Irredeemable means the capital which is not repayable back to the preference shareholders. So in that case, the capital will be paid back only at the time of winding up, only if the funds are available. So that is irredeemable. However, this is just a conceptual understanding. In India, irredeemable preference shares are not allowed as per the Companies Act. And even in redeemable category also, there is a limit on the period within which the capital has to be repaid back. So redemption period in case of redeemable preference shares to be maximum 20 years. So it cannot be more than 20 years. And in case of infrastructure projects, it can be maximum 30 years. But subject to redeeming minimum 10% per year preference share capital from the 21st year onwards or earlier on proportionate basis at the option of the preference shareholders. So the maximum period within which the preference share capital can be repaid back in case of any normal company is 20 years. In case of infrastructure project, it is 30 years. But again, there is a catch that from 21st year onwards, the company has to keep on repaying 10% preference share every year back to them, or earlier as decided with the preference shareholders on proportionate basis. And then only fully paid preference shares can be redeemed. So partly paid preference shares cannot be redeemed. Only if the amount is fully paid up on the preference shares, only such shares can be redeemed back to the preference shareholders. So these are the conditions related to redemption of the preference shares. Another category of preference shares, convertible versus non-convertible. So convertible means these shares can be converted into equity shares at the time of redemption as per the option given to the preference shareholders. Versus non-convertible, in case of non-convertible preference shares, the redemption will happen compulsorily in cash. So they will not have an option to convert their preference shares into equity shares. Cumulative versus non-cumulative preference shares. Now what is cumulative preference share? Let us take an example. Suppose in 2010, company did not declare dividend. So preference shareholders and equity shareholders did not get the dividend. In 2011, company is declaring the dividend. In that case, what happens is, in 2011, preference shareholders will not only get the dividend for 2011, But for the earlier year for which the dividend was not declared, even for that year, that is 2010 in our example, even for that year also they will get the dividend. Even for that year also they will get the dividend. So the right to claim the dividend gets accumulated over a period of time when the dividend was not declared earlier. That is why the name cumulative. And in case of non-cumulative preference shares, it is simple. Suppose in that same example, in 2010 the dividend was not declared and the company declared the dividend in 2011. So then in that case, these non-cumulative preference shareholders will get the dividend only for 2011. So for the earlier year 2010, when the dividend was not declared, they now their right to claim the dividend will lapse. So that is non-cumulative. So they will get the dividend only in the year in which it is declared. Now by default in India, the preference shares are considered to be cumulative and non-participating if nothing is mentioned specifically in the terms of the preference shares. So by default it is assumed to be a cumulative preference share. What it means is that the right of dividend does not lapse, it gets accumulated. And then by default these preference shares are non-participating. That means in the leftover profit after the fixed preference dividend is paid, further the preference shareholders will not have any right to claim the dividend out of the remaining profit. So only then the equity shareholders will have a right to get the dividend. So that is what is the scenario in India. Now having understood the preference shares, now let us come to the equity shares part. So what is equity share? A share which is not a preference share is an equity share. So that means equity shares will not have any priority over the preference shareholders, neither in case of dividend nor in case of repayment of the capital. So no preferential right to dividend or repayment of capital at the time of winding up. Equity shares are never redeemable equity shares, meaning the equity share capital is repaid only at the time of winding up, and that too if the funds are available. Voting right of each equity shareholder is proportionate to his share in the paid up capital. Now these were the types of shares. Now let us understand what are the categories of share capital, be it equity share capital or preference share capital. These categories of share capital are applicable to both. So starting with authorized capital, it is also called as nominal capital or registered capital. Now whenever the company is formed, there is memorandum of association prepared. Now this memorandum of association is basically like a constitution of that company. So it includes all kinds of terms and conditions within which the company is supposed to operate. Now one of the clauses in memorandum is the share capital. So that is the maximum capital which can be raised by the company at any point of time. So since this is a maximum capital, it is also called as authorized capital, or because the memorandum is registered, it is called registered capital or nominal capital. Now beyond that, the company cannot raise the share capital, and if it has to be done, the memorandum of association has to be modified. Now only out of that authorized capital, some capital the company will actually issue, not necessary that the entire authorized capital will be issued by the company. As and when there is a requirement of funds, the company will keep on issuing the shares. So the subset of authorized capital is called issued capital. So issued capital means the capital which is actually issued by the company for as an offer to the people. Out of the issued capital, whatever shares are actually subscribed for by the people and allotted by the company, that is called subscribed capital. Say for example, let us take a simple example that authorized capital is 100 rupees. Out of that, the company has decided to issue. The company has issued the shares worth rupees 90. So 90 becomes your issued capital. Now out of 90, people may actually apply for say 85 rupees worth of shares, and so 85 rupees worth of shares will be allotted by the company. So out of 90, which is issued capital, 85 becomes subscribed capital. Now what happens if people are actually applying for more than 90? Even that can be the theoretical possibility. We'll talk about that when we talk about oversubscription, undersubscription, all those things. So subscribed capital, for the time being, just remember that this is the capital which is subscribed for by the public and allotted by the company. Now 85 rupees are allotted by the company as shares. Now not necessary again that entire 85 rupees will be called up by the company at one go. The company has a right to call up the amount in installments. So out of 85 rupees, suppose 60 rupees are actually called up by the company as of now. Remaining 25 are not yet called up by the company. Then 60 rupees becomes called up capital. And then remaining 25 rupees is uncalled capital. Now out of 60 rupees, if not necessary that the individual shareholders will pay the entire 60 rupees. They may pay only 55 rupees. Remaining 5 rupees will be outstanding. So in that case, 55 rupees becomes paid up capital, and remaining 5 rupees is called unpaid capital, or it is called calls in arrears. Now the capital which was not called up, as I said, it is called uncalled capital. Now out of that uncalled capital, company may decide to call up some portion of the capital at the time of winding up. So suppose out of 85 rupees subscribed capital, we said 60 rupees are actually called up by the company. So remaining 25 rupees is uncalled capital. Now company may decide to, out of that 25 rupees uncalled capital, company may decide to call up 10 rupees only at the time of winding up. Now what is the purpose of this? At the time of winding up, in order to repay the creditors and the lenders, there have to be sufficient funds available. So for that, the company may reserve some portion of the uncalled capital to be called up at the time of winding up. So this reserved portion of the uncalled capital is called reserve capital. So reserve capital is that portion of uncalled capital which is reserved to be called up only at the time of winding up. That is why the name reserve capital. It is not same as capital reserve. Capital reserve is created out of the capital profit. It has got nothing to do with reserve capital. Reserve capital is that portion of uncalled capital which is decided to be called up at the time of winding up. So we also talked about paid up capital and unpaid capital. Unpaid capital is called calls in arrears. Now what happens when the calls are not paid? All those provisions we will talk about when we come to the calls in arrears part. So I hope with up to this everything is clear. Now one more point to be one more point to remember is that sometimes some shareholders may pay something in advance. So if they are paying something in advance ahead of the calls, it is not part of the paid up capital. Paid up capital is only that portion of the called up capital which is actually received by the company. If something is paid in advance, that is called calls in advance. It is not part of the paid up capital. Now in the balance sheet, as per schedule 3, you need to remember that the proper disclosure has to happen in the notes to accounts. So in the notes to accounts, you will have to show authorized capital, and then out of authorized capital, how much is issued, subscribed, called up, and finally, what is the paid up capital. All that breakup will have to be clearly shown as per schedule 3 requirements. In the balance sheet, in the total, ultimately what goes is the paid up capital. So which is called up capital minus calls in arrears. So the paid up capital is part of your balance sheet total. Now whenever the company company decides to issue shares, there are various stages in which the company will ask for the money. So there are various steps in receiving the amounts from the individual shareholders. So what are those various steps that we'll study now? So starting with, obviously the first stage is the share application. So when people are applying for the shares, that time they are not the shareholders. They are just the individual applicants. So when they are applying for the shares, along with the application, they will pay some token amount as per the requirement laid down by the company. So that token amount which is paid at the time of application is called share application money. And there are some clauses mentioned in the Companies Act about the share application money. It has to be at least 5% of the face value as per Companies Act 2013. So suppose the face value of each share is 10 rupees and a particular individual is and the company is issuing these shares at par. So then the application money has to be at least 5% of the face value, which will be 50 paisa in our example, 5% of 10. So it has to be minimum 50 paisa in this case as per Companies Act 2013. At the same time, SEBI has laid down the guidelines for the issue of shares, and those guidelines say that the share application money has to be at least 25% of the issue price. Now here it is not 25% of the face value, it is 25% of the issue price. What it means is that if the shares are issued at premium, that means 10 rupees is the face value and suppose 2 rupees is the extra amount that the company has called up, that is called premium. We'll talk about it in detail when we go to share securities premium. So then the issue price becomes 12 rupees because that is the price at which the shares are actually issued by the company. So then 25% of this 12 rupees becomes becomes the minimum application money that the company should ask for at the time of application. That is as per SEBI guideline. Now between the two, obviously the company has to comply with Companies Act as well as SEBI guidelines. So if between 5% of face value and 25% of issue price, obviously 25% of issue price is the higher amount. So that is why the minimum application money that at any point of time the company should ask for is 25% of the issue price as per SEBI guidelines, so that the Companies Act also is automatically complied with. Then the next stage is, after the share applications are received by the company will start allotting the shares to the individual applicants. So at that point of time, the company will again ask for another installment of the amount, and that is called share allotment money. Now minimum 90% of the issue has to be subscribed before allotting the shares. So the applications received from the individual applicants should be worth 90% of the issue size. So suppose the issue size is say 50 lakhs rupees, then 90% of that, so that is 40, the applications should be received by the company for at least 45 lakhs worth of shares. So then only the issue can proceed further. Now what happens when this 90% is not received? We'll talk about it later. So once the share certificates are actually allotted, then basically the shares come into existence, and then those individual applicants will be called as shareholders. Then on these shares, if the company may further ask for the amounts in installments out of the remaining amounts. So then that is called as share first call, share second call, etc., etc. There is no limit on the maximum number of calls that can be made by the company. The only thing is, whichever is the final call, it is called, suppose the second call is the final call, then it is called share second and final call. Suppose the third call is the final call, then it is called share third and final call. Before that, it will be called as share first call, share second call. The conditions related to calls, the gap between the two calls to be at least 1 month. So in less than 1 month, the company is not supposed to make two or more calls. So between the two calls, the gap has to be minimum 1 month, so that shareholders also get sufficient time to pay the amounts. For issue size up to 500 crores rupees, the issue to be made fully paid up within 12 months. So that means for small issues, the entire amount has to be called up within 1 year. That is what the law says. And each call, another provision related to calls is that each call amount not to exceed 25% of the nominal value. So suppose the nominal value is 10 rupees, then each call amount cannot be more than 2 rupees 50 paisa. So that is the upper limit on the call amounts. So what is under subscription? In simple terms, suppose the issue size is worth 50 lakhs rupees, and people apply for say only 48 lakhs worth of shares, then that is called under subscription. So the number of shares subscribed is lesser than the number of shares issued by the company. Now here one condition is that the minimum in case of under subscription, the subscription actually, the applications received by the company from the individual applicants cannot be lesser than 90% of the issue size. So the minimum subscription required for as per the act is 90% of the issue size. If this minimum 90% is not received, then the issue cannot go ahead, and whatever application money the company has received from the applicants, the entire application money has to be refunded back to them. And that is why there is something called underwriting, which we will talk about later. Oversubscription is exactly opposite of under subscription. So if the issue size was 50 lakhs and the people applied for say 55 lakhs of shares, that is the case of oversubscription. Now please remember, in case of oversubscription, in our example, the company can allot shares worth rupees 50 lakhs only, because that was the issue size. So for extra applications, the company cannot allot the shares, because the maximum number of shares that can be issued is restricted to the issue size. Whereas in case of under subscription, suppose 50 lakhs was the issue size and people applied for 48 lakhs, then the shares can be allotted only to the extent of 48 lakhs, because those were, that was the only that was the amount at which was actually applied for by the applicants. So number of shares subscribed, if it is higher than the number of shares issued by the company, it is a case of oversubscription. Then for what to do with this extra applications made by the individual applicants? So there are three possibilities. Either refund the excess application money and do not allot the shares to those individual applicants, or in that case, if some of the applications are rejected and refunded, then those applicants will get they will not be happy, right? So in order to make sure that nobody is unhappy, there is another option that the company can follow, and that is called pro rata allotment. So pro rata allotment means basically to all the applicants, company will allot the proportionate number of shares. So let us take a very simple example that the issue size was 50 lakhs and people actually applied for 1 crore. So then what company will do? Company will not refund or reject the applications of any individual applicants. Company will allot 50% of the application quantity. So whosoever has applied for 10 shares, he will get 5 shares. Whosoever applied for 20 shares, he will get 10 shares. So because the the applications were received for twice the amount of the issue size. So this is called pro rata allotment. So issue proportionate shares to all and adjust the excess application money against the future amounts due. Or the third possibility can be combination of the two. That is, some applications will be refunded and to the other applicants, the pro rata allotment will happen. So this is what is done in case of oversubscription of shares. Now let us talk about calls in advance. I mentioned it earlier briefly. Now before the call is made, if any shareholder is paying the money in advance, it is called calls in advance. So amount paid by the shareholders in advance ahead of the calls made by the company, that is called calls in advance. Now this calls in advance is not part of your share capital account. Share capital account is supposed to be only part of, is supposed to be the face value called up by the company. Maximum interest payable is 12% per annum on these calls in advance. Whenever a shareholder is paying something in advance to the company, he will obviously expect some kind of an interest on it from the company. So the maximum rate of interest payable is 12% per annum unless the company in general meeting otherwise directs. This interest on calls in advance is a charge on the profit and loss account, a charge on the profit. So no matter whether the company makes profit or loss, once this interest is decided to be paid, it is a charge against the profit. So even if there is a loss, this interest on calls in advance has to be paid by the company. Opposite of calls in advance is calls in arrears. So the call was made by the company, but some shareholders did not pay the call money. That is called calls in arrears. It is an outstanding call amount. Now this calls in arrears is deducted from the share capital account, and that is how the paid up capital is arrived at, and which is ultimately shown in the balance sheet. So amount of call not paid by the shareholders within the stipulated time after the call is made. Now minimum 14 days period has to be given by the company to the shareholders to make the payment of call. So whenever the call is made by the company has to give a period of at least 14 days to the shareholders to pay the call money. If within those 14 days the amount is not paid, then that becomes calls in arrears amount. Now since this is an outstanding amount payable by the shareholders, company can charge interest on this calls in arrears to the shareholders, and the rate of interest is maximum 10%. So maximum 10% per annum interest can be charged on calls in arrears, or lower rate as decided by the board. The board may waive off the interest partially or totally. That is up to the board. Now coming to issue of shares at premium. Now if the face value of the share is 10 rupees, which is mentioned on the share certificate, and the share is actually issued at say 12 rupees. That means the issue price is higher than the face value. So this extra 2 rupees which is asked for by the company is called premium. Now why we need to differentiate this 2 rupees premium from the face value is that this extra 2 rupees can be utilized only for certain selected purposes, and this 2 rupees is never part of share capital. The share capital is always the face value. So if the issue price is greater than the face value, the difference is called share premium. It is not a revenue receipt, it is a capital receipt, and hence it is not shown as a revenue income in the profit and loss account. It is credited to a separate account called securities premium account. And this securities premium account, as I have mentioned in the last point, it is part of your equity and liabilities, and within that part of shareholders funds, and within shareholders funds it is part of reserves and surplus. Now as per section 52 of Companies Act 2013, securities premium balance can be utilized only for certain selected purposes. It cannot be utilized for any purpose not mentioned in this particular section. So what are those purposes for which the securities premium balance can be utilized? A, to write off the preliminary expenses. B, to provide for premium on redemption of preference shares or debentures. So at the time of redemption of preference shares or debentures, if extra money has to be paid back to the preference shareholders or the debenture holders, then this can be used from the securities premium balance which the company already has. And this balance in securities premium is coming from the premium which was collected, collected by the company at the time of issue of shares or issue of debentures. The securities premium balance can be used also for the purpose of issuing bonus shares. So this extra money that the company has received at the time of issue can be later on converted into share capital. Writing off expenses, commission, discount on issue of shares or debentures. So suppose if the commission is paid to a broker, the brokerage charges are paid, underwriting commission is paid, all those expenses or any stamp duty paid, legal charges paid, whatever are those charges which are related to the issue of shares or debentures, these can be written off against the securities premium balance. For buyback of shares, now in the earlier point I have mentioned about discount on issue of shares or debentures, but now as per Companies Act 2013, the shares cannot be issued at discount. The share can be issued at discount only in one particular case, which we will talk about later, whereas the debentures can be issued at discount. And the last use for the securities premium balance for buyback of shares or other securities as per section 68. We'll talk about the buyback in a separate slide. If exactly opposite of securities premium is the discount on issue of shares. So if the issue price is suppose the face value is 10 rupees and the share is issued at 9, then this remaining 1 rupee, the gap between the two is called discount. So if issue price is less than the face value, the difference is called discount on shares. However, please note, this is important, as per section 54 of Companies Act 2013, now the shares cannot be issued at discount by the company. The shares can be issued at discount only in one case, and that is called sweat equity shares. Sweat equity shares is basically employee stock options. So the shares which are issued to the employees or the directors for the services rendered by them, that is called sweat equity. So only in that case the shares can be issued at discount. So sweat equity shares mean equity shares issued by a company to its directors or employees at a discount or for consideration other than cash, for providing their know-how or making available rights in the nature of intellectual property rights or value additions by whatever name called. So for the services rendered by the directors or the employees, the shares which are issued to them are called sweat equity shares, and only in such cases the shares can be issued at discount. In no other case now the issue can happen at discount. If at all the company does that, it is punishable as per the Companies Act. Another concept, issue of shares for consideration other than cash. Now let us take a simple example. I have, the company has purchased machinery from some vendor. Now in return of that machinery, instead of paying cash to that vendor, company decides to issue shares to that vendor and the vendor has agreed. Now what happens in this case? The shares are issued to that vendor, but in return the company has not received cash. The company has actually received machinery. So that is why this is called issue of shares for consideration other than cash. Another example, the promoters who are forming the company, in return of the services which are rendered by them to the company decides to issue shares to them. Now against these shares, again here also the company not receiving any money from the promoters. What the company has received from the promoters is their services. So again this is called issue of shares for consideration other than cash. So shares issued to vendors in return of purchase of any assets or promoters for their services falls under this category. It falls under this category. Such shares to be disclosed separately in the balance sheet. Shares issued to the vendors, the number of shares to be issued will be equal to the amount payable to the vendor divided by the issue price. Now what is the journal entry? Simple, when suppose for example when the machinery is purchased, you will pass the first entry, machinery account debit to vendor's account, and then to that vendor the shares will be issued. So vendor's account will be closed to share capital and to securities premium if at all the shares are issued at premium. So how do we calculate the number of shares to be issued? Please once again note down the formula: amount payable to the vendor divided by the issue price per share. Let us take a very simple example for calculating the number of shares here. So let us take a simple example. If suppose the assets purchased from the vendor were worth rupees 60 lakhs and the face value of the share decided to be issued by the company to that vendor, it is 10 rupees per share. Suppose the issue is happening at par, then what will be the number of shares to be issued? Amount payable, which is 60 lakhs, divided by the issue price, which is 10, because the issue is happening at par. So 6 lakh shares will be issued in that case. So in that case, when the shares are issued, the entry will be vendor's account debit 60 lakhs to share capital 60 lakhs. If the issue is happening at premium, then suppose the premium amount is 2 rupees. So 10 rupees is the face value and 2 rupees is the premium. So the issue price is 12 rupees. So then in that case, the number of shares will be equal to amount payable, which is 60 lakhs, divided by the issue price, which is 12. So the number of shares will be 5 lakhs. So the entry will be vendor's account debit 60 lakhs, because we have to close the vendor's account, to share capital. Share capital is always with a face value. So number of shares is 5 lakhs. Face value is 10 rupees per share. So meaning it is taking the shares back for non-payment of called up money within the stipulated time. Now the articles of association need to have this provision, and these articles need to give the right to the company to forfeit the shares. Now board has the right to forfeit these shares provided at least 14 days notice is given to the defaulting shareholder to pay the money along with interest. So when within those first 14 days the amount is not paid, that becomes a call, that is called calls in arrears. Now it is not that immediately after that the board will get a right to forfeit these shares. Even for forfeiting the shares, later on the company, again the board has to issue notice to the shareholder, which clearly states that if the money is not paid within such and such period, then your shares will be forfeited. That such and such period has to be at least 14 days. So further 14 days will have to be given to the shareholder to pay the money, and within that period again, if the shareholder doesn't pay, then the board gets the right to forfeit the shares. And obviously whenever the amount has to be paid, the amount is paid by the shareholder, it has to be paid by him along with interest. So board resolution is required in order to forfeit the above shares. Once the shares are forfeited, then that shareholder ceases to be a member. Then he cannot be called as a member because the shares are taken back by the company from him. Now the important point that you need to remember is that even if the shares are forfeited, whatever money he has already paid on those shares, that money is never repaid back by the company to that particular shareholder. That money remains with the company only. That is what is the meaning of forfeiture. That is why it is called as a forfeiture. So amount already paid by him is forfeited by the company and transferred to a separate account called shares forfeited account or share forfeiture account. Simple example, suppose one share of 10 rupees was issued, and out of this 10 rupees, the shareholder has paid 6 rupees, remaining 4 rupees are not paid by him in spite of making a call. So if the company eventually forfeits this share, then the 6 rupees which are paid by him, by the shareholder already, these 6 rupees will not be returned back to that particular shareholder. The 6 rupees will remain with the company, which will go to the shares forfeited account. Now once the shares are forfeited by the company, the share certificates or the shares remain with the company now. At a later stage, company may decide to reissue these shares to some other individual. That is called a reissue of forfeited shares. So articles of association need to authorize the board to reissue the forfeited shares at a later stage. What you need to remember here is that this reissue of forfeited shares can be at par or at a discount or at a premium. I have highlighted the word at a discount. The reason is, you remember earlier we discussed that the issue of shares cannot be at a discount as per the Companies Act 2013. However, the reissue of forfeited shares can happen at a discount. The reason is, this reissue of forfeited shares is always considered as a sale of shares. It is not considered as an issue of shares, and that is why the reissue can happen at a discount. That is what you need to remember. So profit on reissue to be transferred to capital reserve. When the shares are reissued, there is a possibility that the company is receiving extra money on these shares in addition to what company was supposed to receive at the time of original issue. So this extra money that the company has received is basically nothing but the profit on reissue, which is transferred to capital reserve. Now how do we calculate this profit on reissue? We'll come to that. The discount on another point that you need to remember is that the discount which the company is giving on the reissue cannot be greater than the face value originally received by the company. Let us take a very simple example to understand both these points. How do we calculate the profit, and what do we mean by that discount cannot be greater than the face value? Suppose the face value per share is 10 rupees. 6 rupees were already paid by the shareholder and 4 are not paid in spite of making a call. Share is forfeited. So the face value originally received by the company is 6 rupees. Now at the time of reissue, company can give a maximum discount of rupees 6 because that was the face value originally received. So suppose company decides to give 6 rupees discount. That means now at the time of reissue, the share is reissued at 4 rupees. 10 rupees is the face value, 6 rupees is the discount. That means the share is reissued at 4. So in that case, what will happen? Originally, company has received 6 rupees. On reissue, the company is receiving 4 rupees. So total 10 rupees are received by the company, which is equal to the face value. Now let us see if the discount, for example, on reissue is say 7 rupees, which is not allowed as per the Companies Act. But just to explain the point, I am saying I am taking this example. Suppose the discount on reissue is 7 rupees. That means on reissue, the company will receive 3 rupees. Originally, company has received 6 rupees. So 6 plus 3, now the company will receive only 9 rupees, whereas the face value was 10. This will amount to reduction in the share capital, which is not allowed. And that is why the condition that the discount on reissue cannot be greater than the face value originally received. Now, how do we calculate the profit on reissue? Let us take, in that same example, let us assume that the discount on reissue was say, 5 rupees. So that means the share was reissued at 5. 10 rupees face value minus 5 rupees discount. So 5 rupees is the remaining amount. So now the share was the face value that was originally received by the company was 6 rupees. The discount given on reissue is 5 rupees. The difference between the two, that is 1 rupee, is basically the profit on reissue. Now let us cross check that in a different way. Company originally received 6. On reissue, company received 5. So in all, company received 11 rupees. whereas the face value is 10 rupees. So extra 1 rupee that is received by the company is the profit on reissue. So simple formula for profit on reissue, please note this down. In the reissue of forfeited shares, you will have to always use this formula. The profit on reissue of forfeited shares is equal to the face value originally received by the company per share minus the discount given on reissue per share, that gives you profit per share, multiplied by the number of shares reissued. That is the profit on reissue, which will be transferred to capital reserve. Now coming to the buyback of shares concept. As the name itself says, it is buyback of shares. That means the company is actually purchasing the shares. Please remember, this is not a forfeiture of shares. In forfeiture, company is forfeiting the share and never returning that money back to that particular shareholder. Whereas in case of buyback, company is actually purchasing it from that shareholder, its own shares. And obviously in return, the company will have to pay the money back to that particular shareholder. So this is called buyback of shares. So it is purchasing of its own shares by the company. Now when does typically company go for the buyback option? So only when the company has excess funds and company feels that these excess funds cannot be utilized for any purpose, there is no business growth, so hence there is no area in which these excess funds can be utilized. So then the company may decide to buy the shares back. So these excess funds will be returned back to the shareholders by way of buyback. Or when the company feels that the shares are undervalued in the stock exchange, so then also the company may decide to go for buyback of shares. Because what happens is, when the shares are bought back, the number of shares floating in the stock exchange will go down. So if the number of shares goes down, it will increase the earnings per share. Earnings per share is nothing but profit available to the shareholders divided by the number of shares. So if the denominator is going down, obviously the earnings per share, the ratio will go up. So if the earnings per share goes up, obviously it will have favorable impact on the share price in the stock exchange. So correspondingly the share price is expected to go up. So in that case, that undervaluation of shares will be rectified. Section 68, 69 and 70 of Companies Act 2013 provide for the provisions related to buyback of shares. Now buyback of shares or other specified securities is allowed only out of the free reserves. What are free reserves? The reserves which are available for dividend distribution. Even the securities premium balance can be utilized to buy the shares back, as per earlier securities premium provisions that we studied. And the buyback can happen also out of the proceeds of a different class of shares or other specified securities issued for the purpose of buyback. So that means the buyback is not allowed from the same class of shares or securities issued earlier. So if the company is issuing, the company wants to buy equity shares back, then for that purpose company cannot issue new equity shares, because then that is the same class of shares. Company can issue preference shares and buy equity shares back. So that is what is the third point. So these are the three sources from which the buyback is allowed. There are certain conditions laid down as per section 68 for the buyback. First of all, the buyback has to be authorized by the Articles of Association. Special resolution has to be passed in the general meeting. This special resolution will not be required if the buyback is 10% or less of the total paid up equity capital and free reserves of the company. Then in that case, the board resolution is sufficient. So buyback to be completed within 1 year after the resolution. So after this special resolution or the board resolution, whatever is applicable, the buyback has to be completed, the whole process of buyback has to be completed within 1 year. Buyback is 25% or less of the paid up capital and free reserve. That is another condition laid down in section 68. So the maximum amount of buyback can be 25% or less of the paid up capital and free reserves. Free reserves always include securities premium when we talk about the buyback. If the buyback is for equity shares, then the condition says that 25% is of the paid up equity capital only in that particular financial year. Then the free reserves are not considered if it is buyback of the equity shares. But if it is buyback of any other shares, type of share, that is preference shares, then the condition is buyback is allowed to the extent of 25% or less of the paid up capital and free reserves. After the buyback, what happens is your share capital will go down, so shareholders funds will go down. So then debt equity ratio, what is the debt equity ratio? Long term debts divided by the equity, that is shareholders funds. So if the shareholders funds go down because of the buyback, what will happen is the debt equity ratio will increase. The buyback conditions, one of the conditions says that after buyback, the company has to ensure that the debt equity ratio does not exceed 2 or 2:1. So basically what it says is that because of buyback, the debts should not become excessive, which will put the company in the danger of insolvency. So that is why the maximum debt equity ratio that can go up to is 2. So the debt can be maximum twice the equity, not beyond that, not above that, because of the buyback. Only fully paid up shares or securities can be bought back. So partly paid shares have to be converted into fully paid up, and then the shares can be bought back. SEBI regulations, Stock Exchange, Securities Exchange Board of India regulations are followed for listed shares and securities. No offer of buyback to be made within a period of 1 year from the date of the closure of the earlier buyback offer, if any. So there cannot be a frequent buyback from the company. So that is why, in order to ensure that, it says that if a buyback was already made by the company, then within 1 year, in less than 1 year, the company cannot go for another buyback offer. At least one year should have lapsed after the earlier buyback offer. This buyback can happen from either the existing security holders on proportionate basis, or security can happen from the securities issued pursuant to stock option schemes to the employees or directors, or the company may decide to buy the shares back from the open market. So it will give the offer for the buyback. Whosoever wants to give the shares back to the company, the company will buy the shares back from them at that particular price, agreed price. So these are the three areas from where the buyback can happen. So please remember, the sources of buyback earlier that we talked about are basically the free reserves or the fresh issue of shares or the securities premium. Free reserves including securities premium, or the proceeds of different class of shares or the specified securities. These are the sources from which the buyback can happen. And these are the shareholders. Here, what we are talking about is these are the shareholders from whom the buyback can, these are the security holders from whom the buyback can happen. Or these are the ways in which the buyback can happen. Either, the securities will be taken back from the existing holders on proportionate basis, or from the employees or directors to whom the stock options were given, or the buyback can happen from the current holders in the open market. The declaration of solvency has to be filed with the registrar by the company before making the buyback, when the shares or securities are listed on the recognized stock exchange. Because it cannot happen that the company has refunded the money back to the shareholders, and now the company has become insolvent because of this buyback. That is not allowed. So declaration of solvency has to be filed with the registrar. Same kind of securities not to be issued within 6 months of buyback. So suppose today the company has bought back the equity shares, then within next 6 months, in less than 6 months, the company cannot again issue the equity shares. That is not allowed. Otherwise, it defeats the whole purpose of the buyback. So very recently, company had bought back the same class of shares. So there is no reason why again the same class of shares should be issued by the company. Or to say the other way, then there was no need for the buyback. If anyway within less than 6 months in such a short term, anyway the same shares were supposed to be issued by the company. Exception, bonus issue or any conversion happening out of pre-existing obligations. That is allowed to happen within 6 months of the earlier buyback. So if the convertible debentures were issued by the company, and then as per the conversion terms, the debentures have to be converted into equity shares. That conversion can still go on even if it is happening within 6 months after the buyback, or the bonus shares can be issued within 6 months after the buyback. A return has to be filed with Registrar of Companies and SEBI within 30 days after the completion of the buyback. Nominal amount of shares bought back from free reserves, including securities premium, to be transferred to capital redemption reserve. So, we discussed earlier that, what are the sources of buyback of shares, free reserves, including securities premium, or fresh issue of shares or securities of a different class. Now, if the buyback is happening from free reserves, including securities premium, then to the extent of the nominal value of shares bought back from this with the help of these free reserves, that amount of nominal value of shares bought back should be transferred to capital redemption reserve. The objective is that the capital redemption reserve can be utilized only for the purpose of bonus issue. Now, when you are buying the shares back, it basically reduces your share capital, but it should not result in the reduction in the share capital of the company, and that is why Act says that whatever buyback is happening from a source other than fresh issue, then that much portion should be transferred to CRR, so that ultimately it will get converted into share capital only at some point of time or the other. Because ultimately CRR, because it is going to be utilized only for the purpose of bonus issue, it is shareholders' money. So it basically gives a guarantee, that amount will be ultimately considered as a share, as part of share capital, and there will not be any reduction in the share capital. In case of fresh issue of shares or others or securities, anyway there is no question of reduction, because on one side you are buying the shares back, but on the other hand, for that purpose you are issuing fresh shares. So that is why your capital does not change. So that is why this provision, that the amount utilized from the free reserves, including securities premium, because securities premium is allowed to buy back the shares, it has to be transferred to capital redemption reserve. Free reserves for this purpose exclude revaluation reserve and balance already existing in capital redemption reserve. These two types of reserves are never considered as free reserves, and hence those cannot be utilized for the purpose of buyback. Buyback is not allowed as per section 70 in certain cases through any subsidiary company, including its own subsidiary company. Through any subsidiary company, including its own subsidiary company, the company cannot buy the shares back. Through any investment company or group of investment companies, buyback is not allowed. If any default is made in relation to repayment of deposits or interest thereon, redemption of debentures or preference shares, payment of dividend to the shareholders or repayment of term loan, or interest thereon to the lender, that is a financial institution or banking company. So basically, whatever are the payment obligations of the company, if the company has made some default, then the buyback is not allowed unless until that default is rectified. Buyback not prohibited if default is rectified and a period of 3 years has lapsed. So if at all that default has happened, it is rectified by the company and a period of 3 years has lapsed, then the buyback is not prohibited. So it is not only necessary that the default is rectified, there shouldn't have been a default in the last 3 years. So that is what the condition says, that it is rectified, 3 years have passed, and then after that the buyback can happen. Company is not allowed to buy back if there is no compliance with section 92, which is related to annual return, section 123, which is related to declaration and payment of dividend, section 127, which is related to failure to pay the dividend, and section 129, that is failure to give true and fair statement. So if at all there is any violation of any of these sections, then again the buyback is not allowed. So these are all the negative clauses which say basically that circumstances the buyback is not allowed. So that was all about buyback. For all these things we'll talk about the journal entries at a later stage. First, let us understand the concepts and then we'll talk about the accounting. Now coming to redemption of preference shares. We earlier said that in India irredeemable preference shares are not allowed. Even redemption also can happen within maximum 20 years and 30 years for infrastructure projects. So what are the conditions for redemption of preference shares as per section 55 of the Companies Act 2013? The preference shares can be redeemed out of free reserves or fresh issue of shares made for the purpose of redemption. Now here one thing that you need to remember is free reserves do not include securities premium, because securities premium is not allowed as per section 52 for redeeming the preference shares or redeeming the debentures. But for the purpose of buyback, the free reserves include securities premium. Only fully paid up preference shares can be redeemed. Nominal amount of shares redeemed out of free reserves to be transferred to CRR. So just like the buyback provision, whatever nominal amount of preference shares are redeemed out of the free reserves, that much amount has to be transferred to CRR, again to make sure that there is no reduction in the share capital. If fresh issue of shares are made, then obviously there is no question of transferring any amount to CRR. Balance in CRR can be utilized only for the purpose of bonus issue. We discussed that. Redemption is not considered as reduction in the share capital, and hence any section related to reduction in share capital, any clause related to reduction in share capital is not attracted because of the redemption of preference shares. Now, in case of redemption of preference shares, how much amount has to be transferred to CRR? So, when the redemption is fully met out of free reserves, nominal value of shares redeemed has to be transferred to CRR. We said that in the earlier slide. Now, when the redemption is happening partly through free reserves and partly through fresh issue, then whatever is happening out of free reserves, that much will have to be transferred to CRR. So, when fresh issue is at par, then nominal value of shares redeemed minus the value of fresh issue. That balance obviously is out of the free reserves, correct? So that will be transferred to CRR. So 100 rupees are redeemed and the fresh issue is of say 60 rupees. That means remaining 40 is happening from free reserves. So this 40 will be transferred to CRR. When fresh issue is happening at a premium, then again the nominal value of shares redeemed minus the nominal value of fresh issue. So in either case, whether it is at par or at premium, the nominal value you will always consider the nominal value, because securities premium is not supposed to come in the picture as far as the redemption of preference shares is concerned. So nominal value of shares redeemed minus the nominal value of fresh issue, not the total proceeds of the fresh issue. Only the nominal value of fresh issue will be reduced from the nominal value of shares redeemed. Again, taking the example, 100 rupees is the nominal amount of preference shares redeemed to be redeemed, and the fresh issue is at say 60 rupees face value and 10% premium. So then while calculating the amount to be transferred to CRR, you will deduct only 60 rupees from 100, not 66 rupees from 100. So that is what this particular formula mentions. Now coming to rights issue. Rights issue is explained in section 62 of the Companies Act, and it says whenever company wants to increase the subscribed capital by issue of further shares, then such shares are to be offered to the existing shareholders. That is basically rights issue. So rights issue in short basically means that it is a right given to the existing shareholders either to accept the further shares or not to accept the further shares. So that is why it is called rights issue, because it is a right given to the existing shareholders. So whenever company wants to increase the subscribed capital further by way of further issue of shares, the shares should be offered to first A category, to whom the shares are to be offered, to existing equity shareholders in proportion to their paid up share capital. Now there are certain clauses related to this particular thing. Minimum 15 days and maximum 30 days notice has to be given to the shareholders to decide whether they want to accept the offer or not to accept the offer. Offer deemed to be rejected if not accepted within this period. So between this 15 days to 30 days period, if the offer is not accepted by the shareholders, then it is assumed that they don't want to accept the offer. Right also includes right to renounce in favor of some other person unless articles provide otherwise. So when this right is given to shareholders to either accept or not to accept, at the same time this right also includes that they can actually renounce this right, they can give this right to purchase the further shares to some other person. That is what they can do unless articles provide otherwise, unless the articles put some restrictions on it. If the offer is not accepted within the above stipulated period, the board can dispose of the shares in the best possible interest of the shareholders and the company. So if the offer between these 15 to 30 days, if the offer is not accepted by the shareholders, existing shareholders, then board has the liberty to dispose of these shares in whichever way they feel is in the interest of the shareholders and the company. So this is all as far as the offer to the existing shareholders, equity shareholders is concerned. Now these shares can also be offered to not only the existing shareholders, but these can also be offered to employees under employee stock option, provided special resolution is passed in the general meeting subject to prescribed conditions. And another category to whom the further shares can be issued to any persons either for cash or consideration other than cash, if authorized by special resolution in general meeting, and the pricing of such issue is based on the valuation report by registered valuer subject to conditions as may be prescribed. So if the special resolution is passed in the general meeting, then it is not compulsory that the further shares should be issued to the existing shareholders or to the employees under employee stock options, but those can be issued to the outside public also, provided the pricing is based on the valuation report by the registered valuer. But for that, as I said, special resolution is required in the shareholders meeting. This section is not applicable to debentures or loans converted into shares as per their conversion terms. So when the redeemable debentures or redeemable preference shares are converted into equity shares, or any loans or are converted into shares, all these things will not affect the clauses related to rights issue. So that is why this rights issue section will not be applicable to the debentures or loans converted into shares, because that was already approved by special resolution earlier at the time of issue of such debentures or loans. So again, all these clauses related to rights issue are not required to be applied for, are not required to be applied. Now, how do we calculate the value of each right share? The value of the right calculated as follows: the market price per share minus the weighted average price after considering the rights issue. So for example, company decides to make rights issue by offering 2 new shares for every 6 shares held. So whosoever is holding 6 shares, he will get 2 new shares by way of rights. Now at the time of making the rights issue, the market price is 250 rupees per share. Company decides to give 1 share of rupees 120 plus premium of rupees 10. Please remember, this is rights issue, this is not a bonus issue. So existing shareholders, if they decide to take it up, they have to pay some price for these shares. So company has decided to give 1 share of rupees 120 plus premium of 10 rupees. So then the current market price is 250. After the rights issue, what will be the weighted average price? For every 6 shares, 2 shares are the rights. 6 shares are at 250 rupees, which is the prevailing market price, and the 2 shares, which are the right shares, are offered at 120 plus 10, that is 130 rupees. So 2 into 130. This will be the total value of 8 shares. So hence divided by 8, that gives you the weighted average share price, which is 220. So current market price is 250. Weighted average price after rights comes to 220 rupees. And therefore the value of the right will be 250 minus 220. 30 rupees is the value of one right. That is how we do the valuation of rights issue. Bonus issue terms are mentioned in section 63 of the Companies Act. A company may issue fully paid up bonus shares to its members in any manner out of its free reserves, securities premium. Remember, securities premium can be utilized for the purpose of bonus issue, or the capital redemption reserve account. So out of these 3 sources, the bonus issue can happen, and the bonus issue basically means giving the shares to the existing shareholders free of cost. So company does not receive any money when the bonus issue happens. Revaluation reserve cannot be utilized for the purpose of bonus issue. And another condition is bonus issue cannot be in lieu of dividend. So when the dividend is, the company cannot say that in lieu of the dividend we are declaring a bonus issue, or to say in other words, the dividend cannot be paid in the form of bonus issue. Other conditions for bonus issue: first of all, that bonus issue has to be authorized by the articles. approved in general meeting upon board's recommendation. So first board has to recommend, then it has to be approved in general meeting. Partly paid shares, on those shares you cannot issue bonus shares, and hence partly paid shares first will have to be made fully paid up, and then only the bonus issue can happen. No default on payment of interest or principal repayment on debt, securities or deposits. Similar clause we saw in case of buyback also. No default on payment of statutory dues of its employees related to provident fund, gratuity, bonus, etc. So on these employee statutory dues, there should be no default by the company. If there is a default, then the bonus issue cannot happen. And if any other conditions are prescribed, then those conditions will have to be followed. A concept called sweat equity shares is also called as employee stock options. Now, what is sweat equity shares? As the name indicates, it is given to employees or directors in return of the services that they have rendered to the company. So section 54 allows the sweat equity shares, and it is allowed of a class of shares already issued. So a new class of shares cannot be issued as sweat equity for the first time. A class of shares which are already issued, only such shares can be issued as sweat equity shares to the employees or directors. So conditions for sweat equity: authorized by special resolution containing all the details of the scheme, including the number of shares, current market price, consideration if any, class of directors or employees to whom this issue is going to happen, the eligibility basically. At least 1 year has passed from the commencement of the business, then only the sweat equity shares can be issued. SEBI guidelines are followed for listed securities, and for unlisted securities any other rules as prescribed are followed. Such shares can be issued at discount as per section 53. You remember in section 53 in issue of shares at a discount we discussed that issue of shares cannot be at discount except in case of sweat equity shares. So that is why such sweat equity shares can be issued at a discount. Now there are certain terms which are used in case of sweat equity. One is called vesting period. Now vesting period means the waiting period till the options can be exercised. So suppose today the company announces the sweat equity plan, and the company says that in order for the employees to exercise this option, they cannot do that for next 1 year. So suppose today it is 10th December, and on 10th December the sweat equity options are issued, and the company says that the minimum in next 1 year these options cannot be exercised. So the shareholders cannot convert this, the shareholders cannot exercise this option and take the shares. So the waiting period is 1 year. The objective is that for next 1 year those employees have to be in the company. Otherwise what will happen is they will take the shares, quit the company, join some other company. Then that defeats the whole purpose of the sweat equity. The sweat equity, the another purpose is basically not only to reward the good performing employees, but also to encourage them to continue to be with the company. So that is why there is some waiting period. So that is called vesting period. So suppose the vesting period is 1 year, then after the 1 year is over, then now the shareholders can exercise this option and take the shares. Then there is something called exercise period. Exercise period says that once the vesting happens, then the period within which the option is to be exercised, after those are vested. So 1 year has passed, so now the employees are eligible to exercise the option. Then the company has put a condition, say for example, that after 1 year has passed, within next 2 months, the exercise or the exercising of the options should happen. And within those 2 months, if the option is not exercised, then that, suppose for example, then that will lapse. So this 2 months period is called exercise period. So remember, first there is a waiting period within which the exercise cannot happen. So that vesting period is over. After that vesting period is over, the shareholders have an option now to exercise the option, and there is a limit on the period within which this exercise can happen. So that is what is called exercise period. And then once assuming that the options are exercised by the shareholders, by the employees. Then, so they get the shares. Then there can be another period which is called lock-in period. So that lock-in period says that once the employees take the shares under this sweat equity scheme, they have to compulsorily hold these shares for certain period of time. So they cannot immediately sell the shares in the market. That is called lock-in period. So it is the period for which the shares are to be held after the options are exercised. So remember, first the vesting period, within which nothing can be done. After the vesting period is over, there is exercise period, within which compulsorily the options should be exercised. If not exercised, those will lapse. Then, assuming that those options are exercised and the shares are taken by the employees, then those shares have to be compulsorily with them for a certain period of time, which is called lock-in period. So first vesting period, then exercise period, and then the lock-in period. Now there is something called alteration of share capital clause. Company can alter the capital clause in the memorandum of association by passing a resolution in the general meeting and giving notice to ROC, Registrar of Companies, within 30 days after the change has happened. So a resolution in general meeting is required to alter the capital clause in the memorandum of association. Articles of association must authorize the company to alter such kind of a clause in the memorandum. Now, how can this capital clause in memorandum of association be modified? There are various ways in which the modification can happen. A, increase the authorized share capital of the company. So that amounts to modification in the capital clause. Consolidate the shares into larger amounts. So each share was earlier of 10 rupees, and now the company wants to increase the face value of each share to 20. So in that case, the number of shares will come down, overall value will remain same, but the capital clause will be modified. Convert the shares into stocks or vice versa, or reconvert the stocks into shares. Subdivide the shares into smaller amounts. So exactly opposite example, the face value currently is 20 rupees, company wants to make it of 10 rupees. So the number of shares will exactly double. The overall value will remain same, but still the capital clause will be modified. Cancel the shares not taken up earlier, thus reducing the capital. This will not be considered as a reduction in the share capital of the company. So these are the various ways in which the alteration of share capital clause can happen in the memorandum of association. Now there is something called underwriting of shares. Now what is underwriting? To explain in a very simple terms, company, earlier we talked about the different categories of share capital. There we said that the issued capital, if suppose for example, if it is not taken up by the people, if it is not subscribed, so it is called under subscription. Now if there is a risk that if the minimum subscription is not received, then in that case the issue cannot go ahead, and the application money will have to be refunded. Now whatever is the issue size by the company, normally that is the fund requirement by the company. So if there is under subscription, that means the company is going to receive lesser money, so which is a risk to the company. In order to avoid this risk, company normally goes for underwriting. Underwriting basically means it is like taking a guarantee of full subscription. So in that case, if there is under subscription, then these underwriters who are giving the guarantee to the company, they will take up the remaining number of shares, so that there will be the gap will be basically breached. So that is called underwriting of shares. Now obviously they will not do it for free. They will expect some kind of returns out of this agreement, which is called underwriting commission. So underwriters give a guarantee to the company that whatever shares are not subscribed by the public, those shares will be taken up by them. Underwriters thus insulate the company, protect the company from the risk of under subscription. They charge some commission for this service, which is called underwriting commission. And this is underwriting commission is a percentage of the whole issue amount in consideration of the risk that the underwriters are taking. So it is a percentage not just of the shares taken up by them. It is a percentage of the whole issue amount. That is what you need to remember. This is an important point. And why are they getting the commission? Because they are taking the risk. If people are not taking up the shares, they will have to invest the amount in the shares of the company. So in return, the commission is paid to them. Now these underwriters can be either individuals, firms, or companies. 2 or more underwriters can jointly underwrite the shares. That is perfectly fine. They are different than the brokers. Brokers are merely acting as agents. They simply procure the subscriptions from the public on behalf of the company in return of brokerage from the company. So brokers do not give any guarantee to the company that the shares will be taken up by anybody or by the brokers. So if the people do not take up the shares, brokers are not going to take up the shares of the company. So the brokers merely act as agents of the company, whereas underwriters are actually taking up the responsibility of buying the shares in case of under subscription. So brokers get brokerage, underwriters get underwriting commission. Now what are the conditions for this underwriting agreement or the underwriting commission? Articles of association must authorize paying such underwriting commission. Commission can be paid out of the proceeds of the issue or profit or both. Maximum commission is that is allowed under the Act is 5% of the issue amount or rate prescribed by Articles of Association, whichever is lower in case of shares. And in case of debentures, 2.5% of the issue amount or rate prescribed by the articles, whichever is lower. That is the maximum limit, 5% and 2.5%. Commission payable only on issue made to the public and not on private placement. So on private placement of shares, there is no underwriting commission applicable. Prospectus to mention the name of the underwriters to whom with whom the agreement is made, commission rate as well as the amount and the size which is underwritten. So we are going to talk about the size of the underwriting in the practical questions. It can be a wholly underwritten issue, it can be partially underwritten issue. So all that size will have to be mentioned clearly in the prospectus. Registrar of companies to be given the copy of the underwriting agreement at the time of delivery of prospectus for registration. So at that time itself, the copy of the underwriting agreement has to be given to the registrar. So types of underwriting. One is called complete underwriting, wherein the underwriters underwrite the entire issue of the securities. Partial underwriting, wherein the underwriters underwrite only part of the issue. So say only 70% of the issue size is underwritten. That is called partial underwriting. Now how the liability gets calculated of the underwriters in case of complete underwriting or partial underwriting, that we'll see in the practical questions. Now there is something called firm underwriting. Now the firm underwriting basically says that that much quantity will be taken up by the underwriters, that those many shares will be taken up by the underwriters no matter what the subscription from the public is. So underwriters undertake to subscribe specific number of securities regardless of how much is subscribed by the public. So the underwriter has to subscribe the shares he has firm underwritten, that is why it is called firm underwritten, plus the unsubscribed shares he is supposed to take under the underwriting contract. So whatever shares are not underwritten, whatever shares are not subscribed for by the public, those shares he will have to take up. In addition to that, he has to take up the firm underwriting shares. Thus, even if the issue is fully subscribed or oversubscribed, the underwriters have to subscribe for the guaranteed number of securities which are firm underwritten. Now, marked and unmarked applications are relevant in case of joint underwriting. We earlier said that 2 or more underwriters can jointly underwrite the issue. So in such case, which is called joint underwriting, the question of marked or unmarked applications arises. In joint underwriting, applications for shares made by the underwriters have to be marked with their stamp for identification. So because there are 2 or more underwriters, Now, who has exactly taken up the shares, the company needs to know, and that is why in the applications made by the underwriters for taking up the shares, though on those applications they have to put their stamp so that the company understands that this application has come from this underwriter, another application has come from another underwriter. It's purely for identification purpose. These applications are called marked applications. In case of single underwriting, obviously this kind of marking is not required because anyway there is only one underwriter. So it is immaterial whether the applications are marked or not. Let us move on to the journal entries. So we'll first see the journal entries for the issue of shares. Now, as I said, basically the first stage in the issue of shares is application money. So company has given, issued the prospectus, given the application forms, and now people have started applying for the shares. And while along with the applications, they will give the token amount, which is basically the application money. So when the application money is received by the company, that's the first time when the company will record the journal entry. So the entry will be bank account debit to share application account to the extent of the money received. Now, this will not be credited to share capital immediately because unless until the shares are allotted, the share capital does not come into existence. So that is why it will temporarily be kept in share application account. Now, after that, after the application, it is the next stage, which is the allotment stage. So at the time of allotment, this application money will have to be converted into share capital. So share application account will be debited to close the share application account, and then that money will be transferred to share capital account. So share application account debit to share capital account. Suppose in case of oversubscription, if some of the applications are refunded back, so then it will be, instead of to share capital, it will be to bank account to the extent of the money refunded, application money refunded. And suppose it is in case of oversubscription, company decides to go for pro rata allotment, then that means what we are saying is for the excess application money, it will be adjusted against the future amounts due. So it will be adjusted against share allotment. So that is why it will be to share allotment account. So instead of to share capital to bank account, whatever is adjusted against the allotment money, it will be credited to share allotment account. So your combined net entry will be share application account debit, that account will get closed either to share capital, to bank account for refund, or to share allotment account for pro rata adjustment. So that is as far as closing the share application account is concerned. Now the share allotment money will become due along with the allotment. So that time the entry will be share allotment account debit to share capital account. Now here you will straight away use share capital account because now the shares have come into existence. And suppose the issue is at a premium, usually the premium is collected at the time of allotment. So that is why that excess amount, which is the premium amount, will be credited to a separate account called securities premium account. So share allotment account debit to the extent of the money due on allotment, to share capital account to the extent of the face value portion of the share allotment amount due, and to securities premium account to the extent of the premium due on allotment. So this was the entry for the allotment money becoming due. now the allotment money will be received. So that time obviously bank account debit. Then if some of the shareholders have not paid the allotment money, it will be debited in a new account called calls in arrears account. Share allotment account will have to be closed. So that is why two share allotment account. If somebody is paying future money in advance, that is the first call money in advance, it will be credited to calls in advance account. So your combined entry will be bank account debit to the extent of the money received, calls in arrears account debit to the extent of money not received on allotment, to share allotment account to close the share allotment account which earlier you had debited, and two calls in advance account to the extent of money received in advance by the company ahead of the calls, future calls from the shareholders. So the logic is same as the allotment. So share first call account will be debited to the extent of money due on the call, to share capital to securities premium. Now this securities premium will be only if the premium is due along with first call. If it is due only at the time of allotment, then here it will be just share first call account debit to share capital account. So it is not necessary that the premium is always collected at the time of allotment. It is up to the company. Company may collect it at the time of first call also. So then in that case, in allotment entry, it will not be securities premium credited. It will be credited at the time of first call. So share first call account debit amount due on first call to share capital face value portion of the first call money and to securities premium account. So this was the entry for the call amount becoming due. Now receiving the call money. So bank account debit amount to the extent of the money received. Then whatever calls shareholders had paid in advance earlier at the time of allotment, that is no more advance now because now the first call is made. So you will have to close that advance account. So that is why earlier you had credited calls in advance account. Now you will debit calls in advance account. If the first call money is not paid by some of the shareholders, that will get debited in calls in arrears account. Then share first call account will have to be closed, which in the earlier entry you had debited. So that is why two shares first call account. And if now the second call money people have paid at the time of first call, then that will get credited to calls in advance account. So two calls in advance account for that amount. So now the first call is over. Now we move on to the second call. Assuming that this is the final call, so it will be called as second and final call. So again the same entry for the second call also. First it becomes due. So share second and final call account debit to share capital account to securities premium account. Exactly same like your first call. Then the second and final call money is received. So bank account debit. Whatever second call money people had paid in advance at the time of first call, now that is no more advance now because the second call is already made. So calls in advance account will be debited to close that account. To suppose the second call money is not received by the the company from some of the shareholders, then that will be debited to calls in arrears. So calls in arrears account debit, and to finally to close the second and final call to share second and final call. Now here you will not have again calls new advance received by the company because this is the last call. So there is no question of paying any advance for future calls. So that is why you will see there is no credit to calls in advance account. So with that the final call also will get closed. Now we have seen here in many of the entries there is calls in arrears account. Now assuming that the calls in arrears are not paid by the shareholders in spite of the notice sent by the company, which gives 14 days period to them to pay along with interest, then the board gets right to forfeit the shares. So if the shares are forfeited, then again a new entry has to be passed. So let us see the journal entry for forfeiture. Now because the shares are forfeited, now obviously those shares are getting, shares are coming back to the company. Those are no more floating shares. So that is why the share capital account will have to be reversed. So that is why share capital account debit. Now please remember what amount has to be debited or credited to all these accounts. That is extremely important. Each and every word that I have mentioned in the slides is important here. So share capital account will be debited to the extent of called up nominal value. So whatever face value has been called up by the company, it's not paid up, it is called up. That amount will be debited in share capital account. So let us take an example that 10 rupees is the face value, 6 rupees were called up, 4 rupees are not yet called up. Then 6 rupees will be debited in share capital account in this entry. 10 rupees will not be debited, 6 rupees, because that is the amount face value which is called up. Suppose the shares were originally issued at a premium, and if the premium is not received by the company from the shareholders, then even that premium will have to be reversed. So that is why securities premium account debit. Only if premium is not received. If the premium is received by the company from the shareholders, there is no question of reversal. So then you will not debit securities premium account here. Then whatever money has been, whatever money had been called up, that you have reversed by way of debit. Now out of that amount, some money is received by the company, some money is not received by the company. So whatever money is received by the company, now you cannot keep it in share capital account. So that is why you will have to use a new account called shares forfeited account or share forfeiture account. So please remember, shares forfeited account will be credited to the extent of the face value received by the company. So out of 10 rupees face value, 6 rupees were called up, and out of 6 rupees, 5 rupees are received by the company. Then 5 rupees will be credited to share forfeited account. And the remaining money which is not received by the company will be credited to calls in arrears account. So to calls in arrears account, amount not received, because earlier you had debited calls in arrears account at the time of issue when the money was not received. Now because you have forfeited these shares, now you cannot call this amount as in arrears. So that is why you will reverse the calls in arrears account. So that is why 2 calls in arrears to the extent of the amount not received, which may include the premium also, if premium also is not received. So this is as far as the forfeiture is concerned. Now after the shares are forfeited, the board may decide to reissue the shares. So now let us see the journal entries for reissue. So when the shares are reissued, obviously the company will get money. So bank account debit to the extent of money received at the time of reissue. Now the reissue may happen at a discount. So if there is a discount on reissue, then the discount will be debited to the account which you had used earlier, which is called shares forfeited account. So shares forfeited account debit to the extent of discount on reissue. To share capital account to the extent of the face value, and to securities premium account if the shares are reissued at premium. So suppose the share of face value of rupees 10 which was forfeited earlier now is reissued at rupees say 8. So that means 8 rupees will be received. So bank account debit 8 rupees. 2 rupees is a discount on reissue, because 10 rupees face value share, it is issued at 8 rupees. That means 2 is the discount. So 2 will be debited in shares forfeited account. To share capital account 10 rupees face value. And there is no premium here. It will be either discount or premium. So this is not there is no premium here. So nothing will be credited to securities premium account. So this is as far as the reissue is concerned. Now at the time of reissue, there might be profit on reissue, which earlier I had explained to you. So the journal entry for that will be basically whatever is the profit on reissue. Currently it is sitting in shares forfeited account. Now you will transfer it to capital reserve account. So shares forfeited account debit to capital reserve account for transferring the profit on reissue to the capital reserve. Now how do you calculate the profit? Earlier I had mentioned the formula. I will explain that again. Profit on reissue is equal to face value originally received per share by the company minus the discount on reissue per share. So that gives you profit per share multiplied by the number of shares reissued. That gives you the total profit on reissue, which you will use in the last entry, that is shares forfeited account debit to capital reserve account. So this is the journal entry as far as the reissue of forfeited shares is concerned. Now with that, basically your all the journal entries end to end for the issue of shares will get over. Now let us talk about the journal entries for other scenarios which we have already discussed in theory. So buyback. Now when the shares are bought back, what are the journal entries that the company will pass? Now for raising the funds, see in buyback what happens is the company is buying the shares back from the shareholders. So obviously company has to pay money to the shareholders. So for paying the money to the shareholders, company needs to raise funds. So the funds can be raised in several ways, either by way of sale of investment, sale of assets, by fresh issue of shares, etc., etc. So for that, for raising the funds, the entry will be bank account debit. If the assets are sold, investments are sold, then to investments or assets account. If the shares, new securities are issued, then to debentures account or respective securities account to the extent of the nominal value of the new shares. If these new shares are securities are issued at premium, then to securities premium account. So this is the entry for raising the funds. Now the time for buyback. So now when the shares are bought back, obviously the share capital will have to be reversed. So equity share capital account debit to the extent of the face value, securities premium or free reserves account debit in case the shares are bought back at premium. So the premium paid, if the extra money is paid for buyback, then that can be adjusted against the free reserves or the securities premium. So that will be debited. So to equity shareholders account to the extent of the money due to the equity shareholders, and to capital reserve account if the shares are bought back at discount. So if it is bought back at premium, then it will be adjusted against securities premium or free reserves. If it is bought back at discount, it is like a profit for the company. So that is why to capital reserve. So it will be either securities premium or to capital reserve. Now the money will be actually paid to the equity shareholders. So equity shareholders account debit to bank account, simple entry. Then we said in buyback, whatever nominal value of the shares bought back is done from the free reserves or the securities premium, that much nominal value will be transferred to CRR. So for that the entry will be, so to that extent your free reserves securities premium balance is coming down. So that is why free reserves or securities premium account debit to capital redemption reserve account. This will be to the extent of the nominal value of shares purchased through free reserves including securities premium. And then finally any expenses incurred on buyback will be charged off in that particular year. So profit and loss account debit to bank account. So these are the entries as far as the buyback is concerned. Now we also talked about redemption of preference shares. So let us see again, the entries for the redemption of preference shares. Suppose the company is issuing fresh shares for the purpose of redemption, then the entry will be company is receiving money, so bank account debit to share capital to securities premium account if the issue is happening at a premium. So company may sell assets also to raise the funds, so bank account debit to assets account. And similar to buyback, any nominal value of preference shares redeemed not out of the fresh issue of shares, then that much portion will have to be transferred to CRR from the free reserves. So for that the entry will be general reserves account debit or whatever name it is called as. So free reserves account debit, whatever it is. So general reserve account debit to CRR. Now the money due to the preference shareholders. So preference share capital account debit because the share capital is coming down. Because the preference share capital is coming down, so preference share capital account debit to the extent of the nominal value of preference shares redeemed. If the premium is happening at, if the redemption is happening at premium, it will be met out of the securities premium balance or general reserve balance. Because remember, in the uses of securities premium, one of the uses is the premium payable on redemption. So that is why here you can utilize securities premium balance. So securities premium or general reserve account debit for the redemption happening at premium, and this amount is due to the preference shareholders. So to preference shareholders account, that is credited. Then the actual payment happening to the preference shareholders account debit to bank account. So these were the entries for the redemption of preference shares. Now coming to the bonus issue. Now bonus issue happens out of the free reserves which are otherwise available for dividend distribution purpose, or these happen out of CRR. CRR can be used exclusively for bonus issue only. It cannot be used for any other purpose. So all these reserves are utilized now for the bonus issue. So all these respective reserves accounts will be debited. So profit and loss account debit, or general reserve account debit, or CRR account debit. Even the securities premium balance also can be utilized for bonus issue. So securities premium account debit, to the extent it is utilized, this is due as a bonus to the shareholders. So to bonus to shareholders account. And when the shares are actually allotted by way of bonus, then bonus to shareholders account will be closed by debiting it and to share capital account, because to that extent your share capital will increase. Now because this is bonus issue and the company is not receiving any money, in these entries nowhere you will see bank account debited. Journal entries for employee stock options or sweat equity. Employee compensation account debit to employee stock options outstanding account, to the extent of the amount recognized as an expense. Now here what happens is basically that suppose the prevailing market price or the fair value is 10 rupees and the stock options are issued at say 4 rupees. That means it is as good as saying that remaining 6 rupees company is bearing on own. Otherwise, if the shares were issued, company would have received the market price, which is 10 rupees. But because the company is issuing the shares at 6 rupees or 4 rupees, the remaining is basically loss for the company, which will be debited. It is as good as saying that the company is giving that much amount to the employees in the form of compensation. So that is why employee compensation account debit to employee stock options outstanding account. Because this is outstanding, because the options are not yet exercised by the employees. Then this compensation will be transferred to P&L. So profit and loss account debit to employee compensation account. Now when the options are actually exercised, that time the employees or the directors will pay that amount to the company, whatever amount was agreed upon. So bank account debit. So in our example earlier, out of 10 rupees, 4 rupees was supposed to be paid by the employees. Remaining 6 rupees will be transferred to employee compensation. So 4 rupees which is received by the company, it will be debited in bank account. Employee stock options outstanding account will be debited now, because now it is no more outstanding. The options are exercised. So remaining 6 rupees is now debited to share capital account to the extent of the face value, and to securities premium account to the extent of the difference between the price of sweat equity and the face value. So let us take an example that the prevailing market price, the face value was 10 rupees and the prevailing market price was say 12 rupees when the options were given to the employees. And out of 12 rupees, company decided to have say 5 rupees from the employees. So then in that case, remaining 7 rupees, that is 12 rupees market price minus 5 rupees options price, remaining 7 rupees will be debited to employee compensation account. Here now at the time of exercise of the options, company is receiving 5 rupees. So in the third entry that we spoke about just now, bank account will be debited by 5 rupees. Employee stock options outstanding will be debited by 7 rupees, because that is the difference between 12 and 5. So total debit will be 12. To share capital account 10 rupees, because that is the face value. And so remaining 2 rupees will go to securities premium account. That's the difference between 12 rupees and 10 rupees. Whatever options are lapsed, which are not taken up by the employees. So amount on lapsed options, that means options which are vested but not exercised within the stipulated period. So those options are lapsed. So for those lapsed options, employee stock options outstanding account will be debited and it will be transferred to general reserve. Because obviously to that extent the amount is not debited in the employee stock options outstanding account in the previous entry. The previous entry was only for the exercise. Now because some of the options are not exercised, there is still some balance lying in employee stock options outstanding account, which you will transfer to general reserve. So these are the entries that we pass in case of sweating. And then the journal entries for underwriting of shares, which is basically like a guarantee given by the underwriters to take up the shares not taken up by the public. So the first entry, out of, say, if the issue size is 100 rupees, 95 rupees are taken up by the public, remaining 5 are not taken up by the public. So in that case, assuming that the whole issue was underwritten, these 5 rupees will have to be taken up by the underwriters. So that is why to that extent the underwriters become our debtors. So underwriters account debit to share capital account, these 5 rupees in our example. Now on the whole issue, commission is due to the underwriters. So commission is an expense for the company. So underwriting commission account debit to underwriters account because it is due to the underwriters. Suppose the underwriting commission is 1 rupee and the value of the shares to be taken up by the underwriters was 5. So in the first entry, you debited underwriters account by 5. In the second entry, you are crediting underwriters account by 1 for the commission. So that means net amount due from the underwriters is 4 rupees, which will be used in the third entry. So 4 rupees bank account debit, because that is the amount that the company is now receiving from the underwriters, and with that the underwriters account will be closed. So to underwriters account. And this underwriting commission account debit is a cost to the company. So that will be, it is a capital loss which will be written off either through the capital profit or by way of writing off through the profit and loss account.